Okay, welcome to this session. My name is Gavin Pannu. In this session, I'm going to do a macro and technical webinar. So I'm going to be covering some of the major macro themes that are at play at this current moment for this week and coming in from the prior week. And then also looking at some of the technical levels that you should be mindful of, or giving you trading opportunities of sectors that you should be looking and potentially investing in. Well, let's start with COVID. COVID's been the major theme, of course, for the last couple of years. But the quick sort of overview over here, this data specifically sort of show me the numbers breakdown by cases and deaths by country. As you can see, sort of US being at number 1, India at number 2, and Brazil at number 3. Brazil's death rates crossed, sort of not the rate, but the number of deaths is above 500,000. So that was a sort of a significant concern, especially that they've got significantly lower cases in comparison to the US. And the total cases, as you can see, right, so 181, we've just crossed through, well, we're almost at 181 and 500,000, 181 million and 500,000 cases, if I can get my words out right. But there we go. And you can see sort of the total vaccine doses that has substantially outpaced the growth that we've seen in cases. So, we're coming up to 3 billion vaccine doses administered, which is great news to a degree. So yes, this is a quick synopsis of the cumulative sort of cases that has occurred, and these are daily cases, right? So we still have these lows over here around the 500k mark. It varies just below the 500k, but yeah, there's no sort of incline as of yet. But saying that, that's not the case. So if I just come back to the economic calendar, if I just move this to the left-hand side, let's just zoom to the right-hand side. So you can see my assets on the right-hand side. You can see the economic calendar. So let's talk a little bit more about COVID. And what I want to speak about is this new, more contagious Delta virus variant. Okay, so we're seeing higher number of infection rates, and it's transmissible to a significant amount in comparison to the previous virus, the previous variant of that virus. And due to sort of the aggression that we've seen with this new virus, this Delta virus, there's been several governments around the world that are being forced to act to prevent another deadly wave occurring of this disease. Yeah. So the UK on Monday reported the most new coronavirus cases since January of this year, and it's mostly being fueled by this new Delta variant. There's been, I think, 10 million Australians have been ordered into lockdown as COVID-19 continues to spread across that country. And this is, we're talking about Brisbane, Sydney, Perth, Darwin. Most of these residents are in some form of lockdown, whether it's a 3-day snap lockdown or up to 2 weeks taking place. The disease has also sort of led to similar measures taking place in South Africa as well. And we're just seeing in Russia, parts of Asia, Europe, and South America are seeing spikes in their COVID cases. Now, if I just come over to, let's see if I've got some stats here to share with you. Just give me a moment. Okay. So these are infections now following similar path to autumn 2020. Okay, so autumn 2020, you can see sort of 1st of September to the 31st of October. These were sort of the cases and the growth had occurred, and this is now. So there is not much difference in regards to the sort of the infection rate has been transmissible from person to person in the UK, and that is causing some level of concern, right? So UKPM, UKPM Boris Johnson and his new health secretary Sajid Javid, who was he was actually the chancellor. He was actually give it a year ago. He went from front bench to the back bench. Now he's back in the front again. Okay, so he was the chancellor of Exchequer a year ago. Rishi Sunak took over, and now he's back on the front bench as the new health secretary. After we all know what took place over the weekend in regards to the previous health secretary and his affair, which took some primetime TV there. So. Okay, but Sajid Javid came out strong yesterday. Just confirming his intention of how he plans, or the roadmap that he's highlighting. So his intention is for all lockdown restrictions to come to an end by July the 19th. There was some discussion that they will, bring that a little bit earlier, but that's not going to be the case. Okay, so there's no significant concern in regards to that. No reason to want to sort of, mitigate away from the July 19 at this current moment. Now, things may change as we see sort of the affection sort of growing at this rate over here. Now, the reason Sajid Javid has made that strong statement that we will still come out of the lockdown July 19th of July is because of this, right? So even though we're seeing what's happening? Even though we're seeing a large sort of numbers of cases occurring, similar to sort of autumn 2020, but there are fewer people being admitted into hospital, which is a very strong positive. Okay, so in comparison to autumn 2020 to now, sort of these 2-month views, you can see there's a substantial difference there. Okay, so and that's largely down to the vaccine. Okay, so the vaccine rollout. There's been more than 44 million people, over 80% of UK adults have now received their first dose of vaccine, and 32 million, or about 60% of adults, have had a second. Okay, so this just shows how many individuals have received their first and second doses, and this is having that knock-on impact for sure. Okay, and just, I think it was just today or last night, there has been some positive data that's come through. And I'll just touch on that in a second. I think I have sort of another view to show you, another sort of chart to show you. So the daily deaths still remain low. Okay, so UK daily sort of reported deaths with coronavirus, with a 7-day average is 17. So it's still at these lows of here, even though we're seeing transmission of this virus is growing. Okay, okay, I don't need that. But let me just bring up sort of this new news that I just mentioned, which is actually quite positive. It's this here. So this mix and match COVID vaccine it will trigger potent immune response. Okay, so mixing the dose of vaccines, whether you're from Pfizer, BioNTech, and you're mixing it with AstraZeneca, University of Oxford, sort of, vaccine, it actually does create a strong immune response. And this is a study that was carried out by the University of Oxford. Now, you've got to remember these studies, you got to take them with a pinch of salt as well, because it does depend on how many individuals were trialed on this study. And you can see there were 600 people. So this was a study based on 600 people. Is that effective enough to sort of, really determine whether that's the true case in the scenario? I'm not too certain, but it does lead us into a more optimistic approach when it comes to these vaccines. Okay, so optimistic view when it comes to these vaccines. And there we are. So that's a sort of a quick synopsis of COVID. Let's move on. Let's move on to something of importance in regards to central banks. Okay, so central banks. Let me just bring up a quick chart over here. So if we go to cable, we're looking at GBP against the US dollar. Okay, what I want to do is, let me just bring this to this side slightly. And we'll bring up the previous week, so last week. There we go, let's go last week. Yeah, so I mean, just talking about what was the most important part of last week's trading session of financial sort of, sessions. It would have been the Bank of England rate decision, okay, and that's what's been highlighted over here. Okay, this took place on Thursday, the 24th of June. It was from midday onwards. So, to give you an overview of this, the Bank of England poured cold water on the speculation that UK interest rates could be raised as early as next year or thereafter, right, in 2022. They are adopting a more wait and see approach, whereas the Fed came a little bit more hawkish, right? In the prior week to that, the Fed came across more hawkish by stating that they're going to raise rates twice in the year 2022. But the BOE are not taking the same approach. Okay, they gave a less hawkish view, or seen as a dovish view, a more of a wait and see approach. Okay, and yeah, I mean that only led to sort of a further a decline in the price of sterling. Okay, so sterling is continuing to move lower. Not only this being sort of the Fed, the initial sort of the Fed impact. If I just have a quick check, 16th. Yep. So on the 16th, you had the Fed sort of rates decision, and that hawkish tone that they gave that led to sterling to sell off, which gives more strength to dollar. So the dollar has more value than sterling at this current moment, and that continued to slide until sort of you come to 18th. This is over the weekend. So over the weekend, in the previous week, a bit of optimism set in. Hang on, the Bank of England's up next. They might also give a more hawkish tone. Which did not occur. Okay, so if I just go back again to sort of last week, and we are focusing on sort of the rate decision on Thursday the 24th, sort of in this region here. There we go. So that was sort of when the rate decision had taken place, and now we're seeing sort of sterling continue to slide, almost approaching back to those significant lows. Okay, so approaching those significant lows. Now, it was already expected that the official sort of rate will stay the same at 0.1%. The vote also stayed the same, 0.09. Okay, vote stayed the same at 0.09. We did have the summary. The summary would have been shared with you at some point from last week. But the MPC Asset Purchase Facility vote. Okay, so this is their quantitative easing program that they have in place, which is of 895 billion on a monthly basis of buying specific assets, whether it's bonds. In majority of it is bonds. But yeah, so you can see it was 0.18. So it was expected that Haldane to vote a cut, a taper of the QE program. I do remember that was Haldane's last meeting. He's actually sort of taking a back seat going forward. Just looking at the chart itself, if I just do a quick full screen here, I like to take it sort of much larger view. I've also spoke about it was just over 5 years ago, we had Brexit occurring. I remember being on the trading floor in Tower Hill and trading all night that session where we saw sort of that Sunderland vote come in, and then we had that significant sell-off. I don't think I'll ever sort of forget that moment occurring. And yeah, that led to this substantial sell-off occurring over here. So we, in 2016 up to around sort of 2018, so a 2-year, almost back up to sort of those highs, go back to sort of retest the Brexit sort of highs, and then we slid down further with a lot of sort of changes from Theresa May to Boris Johnson, and that's where we now start to see where we are now. So Brexit has occurred, we have departed the EU, and we're back at those highs. It's a key resistance level. So this, handle around the 142.50 handle, 142.50 handle is a key level of resistance, as you can see from previous touches in this region over here, and we're seeing a bit of a slide occurring as the central banks. It depends now which central bank is going to show more of a hawkish stance, and what we're looking for is interest rates to rise, or tapering to be carried out, or more hawkish view in the economy, and that's what's going to lead to more strength in that currency. At this current moment, it's a little bit uncertain. Okay, so if I just come back up there, right? So even though we're back at those highs, we could see more of a correction occurring if the dollar strength continues. And that's the Bank of England, okay, from the previous week. So that covers everything that's happened so far. Now, what do we have to look forward to this week? So if I just now, what I want to do is come back to this week's data. Now, just keep an eye on sort of, high impact news being the ones in red. Okay, so that's the ones that I want to be focusing on. There's a couple of sort of oranges. You'll see some oranges. These are mostly sort of, could be speeches, medium impact news. But yeah, let's get straight to what's the sort of, key areas to focus on. The majority of the news that we expect for the week ahead is going to be over the other side of the Atlantic. Okay, so it's US data, mostly US focus. Yes, we do have a couple of speeches. We're expecting sort of on Thursday the Bank of England Governor it's not Carney anymore, it's Bailey, Andrew Bailey, to also speak and give us his views of the economy. But again, that's not going to be as significant as there's two key sort of ones that I want to focus on. Well, firstly, let's start with the OPEC GMMC meeting that's going to be occurring. Yeah, so let's bring up the oil markets. Okay, so there we are. We're seeing sort of crude oil. Yep. So WTI crude oil over here. We're sort of at the 73.15 handle. You can see sort of, the rise and the recovery in crude oil. Do note that, this is not the floor. This was not the floor of crude oil. In the futures market, contracts went to negative $37. So from negative $37, we're back up to around $73, $74. Okay. But anyway, okay. So now, there are three key areas that I'm focusing on when it comes to oil this week, right? Well, firstly, there are meetings that are going to be taking place, or resume, shall I say, resume. There are negotiations going to be resuming between the US and Iran regarding the revival of a nuclear deal. Now, if it's a successful outcome that occurs from these negotiations and these meetings, we could see the US relax their sanctions against the OPEC member. Okay, and that will be pivotal for the oil markets, and that could actually even be the driver for oil sort of breaking through 75 handle and sort of testing these highs that we've not been in multi years. Now, oil prices, you could clearly see it's been rising for 5 consecutive weeks as fuel demand grows due to sort of strong economic recovery and an increase in travel, especially now we're coming into the summer months. And therefore, that comes us to the second point. With this meeting about to take place, right, with the OPEC Plus members, they are currently producing 2.1 million barrels per day. Okay, and that's this is from May's data. Okay, this is from May's data. Now, and that's from so that's from May towards the sort of the end of this month. Okay. Now, as they continue to ease last year's huge supply cuts that had taken place, there was a substantial amount of supply cut that had taken place due to coronavirus, right? The lack of sort of oil being used, they had to sort of stop producing oil for some time, okay? So they cut those supplies substantially. Now it's about how quickly are they going to ramp up producing oil. That's the focus here. So the anticipation is that, they might give indication that from August onwards, they may raise the amount of barrels of oil being produced by 500,000. Okay, and this on a monthly sum. Okay, sorry, per day basis. This is barrels per day. So, yeah, I mean that could have some impact in the price of oil reaching these highs around the 73 mark is where we see currently. But yeah, at this, with this expectation leading into this, into the meeting that's going to be taking place towards the end of this week. I mean, in the very short term, if I come up to the 30-minute time frame, you can see there's been a bit of a decline in prices. Okay, so reaching these highs around 74.50 handle, 74.50, 74.60 handle, is come off around the 72 region, and that's partially the reason why. The reason is because of that expectation of an increase in the production levels occurring, and them giving that indication from August onwards. Now, if we sort of apply a moving average, go back to the 4-hour time frame, you can see on the 4-hour time frame, this is just a dip at this current moment. We can see already a bit of a recovery taking place. So we did spike through the 50 moving average. We did spike through the 50-period moving average. It's done that previously. It's recovered. It's done it a few times. It's recovered. So there is still more buyers in the market at this current moment. There is still more demand by the buyers than there is for sellers. Okay, so I wouldn't be too concerned. But this is going to be a very volatile week when it comes to trading the oil markets. Okay. Now, the third key point I wanted to mention of concern is, of course, even though despite the cause for this optimism that we're seeing with a growing oil demand, investors are still going to be wary of the increasing spread of this new Delta variant. And if there's any other variant of this nature occurring, I think there was mention of a Delta plus. So, as we see, these infections growing, that could hinder the oil market, especially that we've seen Australia going into a lockdown. It's a very short-term lockdown, but still there are sort of restrictions, there are curbs occurring, more infections are occurring. So that is probably the downside for the oil market at this current moment. Okay. Yeah, so just be mindful of this meeting that's going to be taking place, and just to sort of come back to Looking on a Wednesday, you have crude oil inventories. Okay, so crude oil inventories. This is telling us how much oil is being stored at this current moment. Okay, so you can see it's been negative numbers in the past, and we're looking at sort of these. It's been kind of a lot of misses, a lot of sort of negative numbers. So you can see they at some point they do need to ramp up the production levels if the demand really starts to step in. But yeah, you've got to just view it and go with price action and what you see. This current moment, we're seeing a bit of a recovery. We've not broke through the 50 and stayed below the 50 for some time, this current moment. Okay, and finally, that brings us to the final sort of key to this week's trading session is the non-farm payrolls. Now, this occurs on the first Friday of each month. Okay, so first Friday of each month. Now, what shall we have a quick view at? Let's look at Eurodollar in this case. Okay, so we can see sort of Eurodollar selling off. Let's just remove some of this. Right now, we're seeing Euro move off substantially lower. Okay, we're seeing Eurodollar move lower, and now that's just showing us that there is a lot of dollar demand. So if I go to the dollar index, you see the opposite of that. So you see the inverse of that. Okay, so maybe we'll stay on the dollar index as a better gauge in regards to the non-farm payrolls. Okay, so now key part. What I wanted to discuss when it comes to non-farm payrolls is a couple of sort of key points to help you navigate when it comes to trading this session. Now, if I go back to last week's session again, and what I'm looking for is this here, right? So last week on Friday, 25th of June, right? It's seen as a medium to low impact news, but we have core PCE data being released. Okay, PCE data was released, so personal income, personal spending, and this data is quite important. Right, especially the PCE, core PCE data. Okay. Now, why is it important? The Federal Reserve, they released this. This is the U.S. Personal Consumption Expenditure Price Index. It is actually a favorite indicator for the Fed in regards to reviewing inflation. Okay, so we're not seeing a substantial gain, right? So it actually missed the expectation here. So even though, yeah, the increase, there was a 0.5% increase, but it was the less than expected 0.66%. That was in that sort of that orange line that you're seeing just above there. Okay, so it came in lower than expected, which did alleviate any concerns that inflation is getting out of control. So that's a good, thing to sort of take away from that PCE result there. But, the year-on-year rise of this index is around 3.4%, which is the highest level since 1992. Okay, so that's leaving an element of caution in the markets that the Fed may be forced to raise interest rates sooner than expected. Now, I'm just having a quick look here if it's on here somewhere. There was a speech that had taken place last week. Can't quite see it if it's on here at this current moment. But this speech that had taken place last week, it's not on this because it did take place on the Friday after the core PCE was released. And it was by Eric Rosengreen. Okay, Eric Rosengreen. Please do sort of research this and who he is. He is the president of the Federal Reserve, the Bank of Boston. Okay, so one of the key points he stated. So he from his speech he stated that we have a sustainable inflation rate and that we're at full employment. So that could lead us to raise rates sooner than expected. Okay, so those are the two key measures he's looking at. He's not just looking at inflation anymore. He's actually saying, how quickly we get to full employment will be a good indication to raise interest rates sooner than expected. And that's the key point for this week. Okay, so coming back to this week, I'm going to average, so non-farm payrolls. So the two key areas that I'll be focusing on, I'm not focused on average hourly earnings as much. That's not the focus. The focus is the unemployment rate and the non-farm employment change. More so, unemployment rate is going to be the focus. Okay, so the US was achieving record lows. Look at these lows, right? So the unemployment rate in the US, look at this, sort of, from 2010 being at the highs around, what is that? You could say about close on to about 10%. From that point on, we went all the way down to sort of lows in this region here around, let's have a look. Why is it not indicating? So you're seeing about 3.5%. Okay, so 3.5% being the lowest that we had achieved. And then we had a sharp rise up to around 14, 16%. And then we're seeing this decline. If this continues to decline, inflation continues to rise, that's a great indication that the Fed may raise rates or taper sooner than expected. And that's the key there, guys. That will be the key. Okay. Now, yes, and that's why we're seeing a lot of dollar strength coming in, right? We're seeing positive data. Well, firstly, the Delta variant hasn't had too much impact in the US. That's a very strong point there. Employment levels are, coming back in line, and inflation is a little bit hotter than expected, but it's still fine, and it's not and it's not, and the view is that it's not going to be enforced for a prolonged period of time. Okay, it's more transitory at this current moment. So, and that's why we're seeing a lot of demand for the dollar. So the dollar's rising, but at the same time, it's weird, right? So we're also seeing the equity markets make all-time highs, and there's that inverse correlation which hasn't taken effect. So it's like, who is right at this current moment, right? So, is the economy growing at a faster pace than all other countries at this current moment? And that's what we're seeing overall. Now, the inverse to the dollar index would be gold. Let's have a quick look at gold. And there we go. So we see the inverse move occurring in gold. Now, let me just remove some of this analysis here. Let's just do sort of a large upward move. I think I've spoken about this previously, how we had the sort of the Fed decision that came through, a very sort of a bit of a hawkish stance, and sort of 2 rate hikes expected in 2022, and that led to sort of a decline in the demand for gold and sort of reaching the lows around the 1750. So if we got down to 1760 in this region here, and that's where we've been stabilized. So you can clearly see a market's been stabilized in this region here, and this is a very good level of support. This sort of zone I've highlighted here. If I go to the sort of the weekly time frame, maybe the day time frame may be better. So you can see how there has been previous times that price has been supported in this region. Okay, not only as as a support level where price bounces and moves up higher, but also as a resistance as it goes up to retest those highs and then more sellers step in. So it's a very sort of clean level. Now what we do from here is key. So I can give you some insight to that also. So in my opinion, we've seen gold prices move, stay at these lows and move probably a little bit lower so far. We're seeing sort of, from yesterday's session and today's session, it's moving lower. And that's just largely due to the flow of capital into riskier products, right? So if you're seeing equities at these all-time highs and the demand for tech companies that are performing really well, and I'm going to talk about the banking sector as well, that's outperforming, there's going to be less demand for a safe haven, and that being gold. So, and that's what we're seeing here. So that's probably sort of the key point to stress there. Gold is being less sensitive towards yields, so bond yields, and it's and this inflation chatter has subsided. Okay, subsided. It's not the number one theme. The number one theme is now the Delta variant. Okay, so and that's why there's more less demand. Gold is a bit lackluster currently. Okay, so yeah, I think if the Fed sort of hawkish shift at sort of the next meeting occurs, that could have a more of a negative impact in gold, if anything. So we're now focusing on what is the Fed going to do in August. So the Fed may announce a tapering of its QE program, and this is going to take place in August, late August, where they have the Jackson Hole meeting taking place, the Jackson Hole Symposium. So just keep an eye out for that. And if we have a more of a hawkish tone, then actually we may see gold slide further. So even though I love this region, the support region, as a very good strong support area at this current moment, and it's holding up prices, it's holding up the price of gold, it's propping it up a little bit, but I would state to be cautious at this current moment, because we could easily see gold being penalized because of the Fed's demand for rate hikes or tapering, and then the strength, and then the focus goes onto the dollar strengthen, the dollar index, and that continue to strengthen. So you've got to be very cautious when you're trading gold at this current moment. Okay. Now, on to sort of the next key point. Let's have a look. So I want to talk about banks, okay, banks in particular. So if I come back to JP Morgan, I'm just solely focused on US banks, not sort of European banks or UK banks. How do I get rid of this? Let's move that there. Remove this. So JP Morgan, here we are. So JP Morgan Chase's increases quarterly dividend. Now, this news comes after last week the Fed released the results of its annual stress test, and it said all 23 institutions in the 2021 exam remained well above minimum required capital levels during a hypothetical economic downturn, which included a severe global recession. So that means that these guys, these institutional banks, and these sort of general banks, right? All 23 institutional banks have enough capital reserves to meet any substantial sell-off or panic or economic downturn that could occur. That's a huge bullish view, right? That's a hugely sort of bullish view for anyone that's trading banks. Okay, so that's one point. The second point I'd mention is that there's been an IPO boom. What is an IPO? Initial public offering. So these new companies being publicly traded. Okay, there has been a IPO boom. SPACs as well. SPACs are doing well, but let's focus on IPOs. That's where the institutions, banks are working with. So investment banks are doing well. They are. What they do is they generate deal making and advisory fees from every IPO that they work on. Yeah, so that's the sort of key points there. Now, in addition to that, the fact that they are now mentioning that they are likely to increase their dividend rates, though some of them are going up by 20%, 40%, 60%, and even 100%. I think JP Morgan's doubling their dividends. But at the same time, they're going to do share buybacks, so that they're going to be buying their outstanding shares of their own company. Okay, so that's what they're going to be doing, which actually props up the share value. So in my opinion, what seems to be a bit of a buy at this current moment is US bank shares. Okay, so there should be more demand for US bank shares and stocks. So just review them. Look for something that's sold substantially. So at this current moment, even though if I look at sort of JP Morgan, we're looking sort of the majority of this year, you can see sort of this is sort of COVID, right? So COVID occurring, bit of a sell-off, bit of a sideways action, and look at the recovery on this. Look at the recovery on that. Okay, so you can see sort of we're looking at sort of from the low of the panic with COVID in last year, sort of March, April, to where we are now. We're up 120%, 118%, up 118% so far. So yeah, and already in the pre-market, it's looking to sort of gap a little bit higher. So for sure, there's definitely demand when it comes to the banks. Yeah, there's quite a few that I've got to get through. Apologies if I'm not coming through to your questions. I'll try and make time at the end. Okay, so finally, well, I keep saying finally, but I've got two more sort of key parts I want to talk about, which shouldn't take too long. Okay. The next part sort of to discuss, if I come back to the calendar, come back to, let's have a look, today, and it would be, is this. At 7 a.m. this morning, nationwide HPI month-over-month figure came through, okay? So I don't need that, I need this, right? So there is a bit of a bid with home builders in the UK, and then they've been the best performing, and they're reacting strongly to this industry sort of data from nationwide. So what this is showing us that is UK house prices continue to surge in June with the highest rate of annual growth since November 2004. So figures from the mortgage lenders show that the rise that we've seen, right? So on an annual basis, the nationwide house index jumped up by 13.4%. In the month of June. So yeah, so that's a year-on-year figure, because that's the annual basis up to the month of June. That's the highest level since, as I mentioned, 2004. Okay, London house prices have gone up by 7.3% in this quarter alone. Okay, so yeah, I mean, this is sort of a huge knock-on impact. So it's up at around 0.7%, in line with the expectations. This is great news for anyone that's a homeowner. Okay. Now, what's led to this? Well, the domestic housing markets, just the continued they've continued to benefit from borrowing costs. So, interest rates being at these record lows, but also UK government stamp duty holidays on purchases, which have come to an end or are coming to an end at the end of this month. So there's been actually less mortgage application at this current moment. And just mortgage lenders, they're offering first-time buyer schemes with little deposits required as well. But also the demand for individuals wanting to, who've lived in a nice flat in London, but want to, can escape the city life and have a nice garden, have more of a, more luxuries or more facilities, as they are able to now to have that additional option of being able to work from home or flexible hours. So we're seeing a lot of demand in that also. So yeah, just to bring up a quick chart now, I do have a, oh, no, just one second. Where is it? So this gives you sort of a quick indication, right? So this is the latest data released by the UK Nationwide Building Society. This is average UK house prices, okay? This is the average UK house prices, not London house prices, just the whole of UK. Okay, and you can see sort of, look over the years, right? So this is sort of 2011, right? So multi-year view, but just in the last year alone, right? So you can see sort of, around the 220, sort of reaches a low around 220 a year ago, right? And since then we're around close enough to around the 250 mark for an average, for the UK average house price. So a lot of demand coming in the housing market, and we're seeing, for example, let's say Taylor Wimpey. Taylor Wimpey's, up. Let's have a look if I've put the stocks here to Taylor. We want the LAC. There we go. So, if I just, so I mean, overall, you can see a bit of volatility, but there is more demand for this particular asset and just the housing stocks overall. I believe Barratt Developments is up as well. So let's have a quick look at Barratt. Oh, just one second. All right, development. Let's have a look if I don't know what the specific concept by putting in developments. Does anyone have the ticker? Does anyone have the ticker? Let's try FAR. Not quite sure. Okay, doesn't really matter, but you get the point, guys. You get the drift, right? So the housing sector is outperforming. Okay, yeah, I think that sort of wraps things up. So before sort of, we come to the end of this session, there's one sort of final key point that I wanted to stress here. Is Facebook. Let's have a look. So I know the ticker for that. That's FB. There we go. So looking at Facebook, what's so important about this? Well, a federal judge dealt a major blow with US regulators' efforts to break up Facebook. They're calling it a monopoly, right? So dismissing 2 complaints that accuse the company of holding a monopoly in the sort of social media region or sector, whatever you want to call it. And yeah, and this is fantastic news for Facebook because it shot up substantially from this. So much so that if I go to financials and I type in market cap, they have just breached the 1 trillion market cap valuation. Okay, they are worth 1 trillion, just above the 1 trillion mark already. So if you want to sort of review that, it says right there, 1.008 trillion. So yes, tech is strong. Tech is doing very strong. Okay, that brings me to the end of the session. Thank you for joining this session. Feel free to ask any further questions whenever you can, and I'll be in touch with you soon. Thank you.